Hello, guys. So now let's discuss a question from ethics. So most probably you can expect an ethics question in section A. Okay. So let's read the question. Okay. So Sycamore and Company is actually a listed company. Okay. And they are basically providing the software. Okay. Softwares. And the audit team comprises an engagement partner. Okay, and a recently appointed audit manager and audit senior and number of audit assistant. Okay, and the audit partner. Okay, the audit partner has been appointed this year. So the audit partner is also new to the audit client because of the rotation of the previous partner. Okay, so the previous partner is actually in rotation. Then the audit senior, okay, the audit senior has the experience of auditing the company in this specialized industry. So, audit manager, audit partner, both of them, they don't have a experience in auditing this particular, industry. Okay, and the previous audit manager, who is a close friend of the new audit manager. Okay, that's the next problem. So the new audit manager and the previous audit managers, they are friends. Okay, and this previous audit manager now a finance director with the FIR company. Who is the FIR? Who is FIR company? FIR company is our client. That's the next issue. Okay, and the FIR company is actually requesting the auditor to provide some non-audit services. First one is routine maintenance of payroll records, assisting in the selecting new financial controller, then tax services, where we have to liaise with tax authority. All right. Then Sycamore and Company identified that the current year fees to be received from FIR company for the audit and other services will represent 60% of the total fees from total fee income. So this year, the proportion of the fees collected will be 16% of the total fee of the firm. And previous year it was 15.5%. Okay. So this is a listed company, right? So there is a risk of fee dependency, right? Fee dependency says that it should not be the income from a particular client should not be more than 15% for a consecutive 2 years. So here you can see if we provide the non-audit services, okay, if we provide the non-audit services, the fees collected will be 16%. And previous year it is 15.5%. So there is a risk here, right? There is a risk of self-interest here, right? Okay. So I hope you clear I hope you know the ethical safeguard, right? What's the safeguard here? What's the safeguard? I'm repeating, for 2 consecutive years, the fees collected from a particular client should not be more than 15%. But here, this safeguard is not followed actually. Okay. So it's a threat actually. So it's a threat to the self, it's a self-interest threat actually. Okay. So I'm reading the question. First one. In case of the composition of the audit team, which of the fundamental principle is at risk and provide safeguard? So what's the problem with the current team? So the problem with the current team is that only the audit senior has the experience in auditing this particular client. Okay. So the audit partner, audit manager, both of them, they don't have an experience in auditing this particular client actually. So the problem is there is a lack of professional competence. There is a lack of professional competence. What safeguard? Is it reinstate the previous partner? Can we reinstate the previous partner? Can we reappoint the previous partner? Is it possible? Is it acceptable? No, right? Because the previous partner is actually in rotation. Actually, rotation. It's actually rotation. Rotation means the cool off period. The previous period is in the cool off period. So we cannot reappoint the previous partner. That is not possible. That is not logical. It's not acceptable. The other way, it says that provide industry training for the team employee. Yes, that will solve the problem, right? If we provide the training for all audit partner and audit manager regarding this particular industry, okay, so this will solve the problem. So option 4 will be the right answer. Okay. Okay, so please listen, the partner and the audit manager, they're lacking the experience in auditing this particular industry. They have audit experience, but not with this particular industry. So that's why if we give proper training, this will solve the problem. Okay. Question 2. In case of the previous employment with Sycamore company, recommend the appropriate safeguard. Okay. So here, the new audit partner and the previous audit partner, sorry, not the audit partner, the current audit manager and the previous audit manager, they're very close friends, right? So here there is a familiarity threat. Here there is a familiarity threat. So what will be the safeguard? Resign from the engagement? No. Instead of that, instead of thinking of resigning, we can do what? We can remove this particular manager from the team. So we can reduce the familiarity threat, or we can eliminate the familiarity threat, right? So option B with the right answer, right? So if we remove the audit manager from the team, this will solve the problem. Okay. Third one, in case of the non-audit services, which threat will be occur? So first one, routine maintenance of payroll records. If we maintain the payroll record, and we audit the same, this will lead to self-review threat, right? So first one is self-review. Okay, first one is self-review. Second one, assisting the in selection of the financial controller. So which one? It's actually a self-interest threat. If you're assisting them for financial controller for the recruitment and all, it's a self-interest threat. Third one, we are liaising with the tax authority. It's basically the communication. We are communicating with the tax authority. We are, promoting the client in front of the tax authority, right? So it will be a advocacy threat. So 1, 2, 3. So option C will be the right answer. Okay. Okay. So how this assistance in checking the reference for financial controller, how this will be a self-interest threat? Because if they're providing this services to the client, the auditor can earn more, right? They can earn more audit fees. That's why it's a self-interest threat. Okay. Then the fourth one, which of the following would not be relevant in mitigating the threat in case of relation to the fees? So we have to select an incorrect option. So here you can see 4 safeguards here. So out of the 4 safeguards, 1 safeguard will be incorrect and 3 safeguards will be correct. So we have to select the incorrect safeguard in case of in relation to the fees. So in relation to the fees, the ethical threat is, what's the threat here? Fee dependency. So what safeguard? What's the incorrect safeguard in case of the fee dependency? Which one? Option C. Why? Option C says that use separate team to provide audit services and non-audit services. So this will solve the ethical issue. What they are suggesting is that separate the team. So one team will do the audit, other team will do the non-audit services. So does this will reduce the audit fees? No, right? The total audit fees or the audit fees collected from the client is not going to reduce. There is a risk that it will increase actually, because if you are appointing 2 teams, the fees will increase. The fees is not going to decrease, because we want to decrease the fees, right? We want to reduce the level of fees actually. It should come below 15%. Now it is expected as 16%. We have to reduce this below 15%. So if we appoint 2 teams, does this make any changes? No. right? This will not make any changes to the fees. So option B is the incorrect, safeguard. The other three options are correct safeguards. You can communicate with the those self-governance pre-issuance review. What is pre-issuance review? It's the review conducted before issuing the audit report. Okay, so an external reviewer will review the audit report before issuing it, so that if there is any compromise in the ethical principles, the qualified accountant or the external accountant will detect that. And what is post issuance review? It's a review conducted after issuing the audit report. So this can also helps to find out any breach of ethical principle or any ethical issues. But option C will not solve this fee dependency problem. Okay, clear? So by conducting the review, we can identify that if there is any compromise in the ethical principle or audit quality due to fee dependency. That's why we are conducting, the review. There are two types of review: pre-issuance and post-issuance. Pre-issuance means review conducted before issuing the audit report. Post-issuance means review after issuing the audit report. Clear? The last one. So here there is a confidentiality issue they are mentioning about. So if your company is a suspicious cash transfer has been identified, and the audit team has reported this to the relevant representative as a potential money laundering transaction. So if your company is involved in a money laundering transaction, so as an auditor, we have a responsibility to report this. But we are concerned about the confidentiality. We are concerned about the confidentiality issue. So what do you think? What do you think? Think about this situation. If we report this to the authority, there is a breach of confidentiality, right? Right, because it's a client's information, right? So what do you think? Let's read the requirement. Details of the transaction can be only disclosed with the permission of fair company. Is it right? So listen here. Here, the client is involved in an illegal activity. So as an auditor, we have a legal responsibility. We have a legal responsibility to report this to the relevant authority. So since we have a legal authority, legal duty to disclose, we don't want to bother about the confidentiality, right? We don't want to consider the confidentiality because we have legal duty to disclose to the authority about this, money laundering. So even if you don't have a permission for with from fair company, you can disclose the information if you have a legal duty. So if you have a legal permission, you don't want a permission from the client. Okay, clear on clear. So first option is wrong actually. We don't want the permission of the client. If we have a permission from the government, we can disclose the information, right? So option A is wrong. Option two, if there's a legal requirement to report money laundering, this overrides the principle of confidentiality. Yes, it's correct. Because if you have a legal duty, we don't want to care about the confidentiality. So confidential agreement is cancelled here. We don't want to consider the confidentiality. So option 2 is correct. Let's read the option 3. Sycamore is not permitted to disclose information because this is obtained during the audit. Is there any such provision? No, right? As we mentioned, if you have a legal duty, you can disclose information. Even this information is obtained during the audit, no problem. So option C is wrong. Option D, to maintain confidentiality, we should report this issue anonymously. Is it correct? No. If we are reporting the issue to the government or relevant authority, you should disclose your identity, not by anonymously. Not anonymously. You should disclose the identity. So, but the only thing you have to be careful about is you should disclose the issue with the relevant authority. That's the only thing you have to be careful with. So option B will be the right answer. Okay. So if you have a legal duty to disclose, this will overrides or this will cancel the principle of confidentiality. Okay. Clear? So please make sure you practice maximum questions from ethics, because ethics is highly examinable under section A, or this is going to test in your audit exam for sure. Okay, so most probably this will be examinable under section A. 10 marks you can score. Okay.